Prop firms might be pissed off at me for making this video, but I feel like as somebody that actually wants retail traders to succeed, in all transparency and honesty, I have to make this video exposing the prop firm industry. And not only the prop firm industry, but the entire Forex industry as a whole. And most people are completely unaware of what's actually happening to them behind the scenes. And I wasn't really aware of this till several years into my trading career until I actually spoke with a Forex broker owner. And so in this video, we're going to be covering three main things. Number one is how prop firms actually used to make money. Number two is how prop firms actually make money today. And number three, what we call their secret weapon, which is something called a virtual dealer plugin. And I'm going to show you 5 different ways that they use this little tool to suck money from you. And the reason you should listen to me on this subject is because we've helped over 600 people become funded prop traders. We once had our own prop firm and we've looked seriously into buying our own brokerage and ultimately decided against it because of what I'm going to share with you in this video. Okay, so first things first, let's take a look at how prop firms actually used to make money. So the way that prop firms actually used to make money was like this. There would be people, right, me and you, that would go and we would put our hard-earned money into either a bank or some sort of fund, right, where we'd secure our money. Now, the bank takes our money and it doesn't just sit there and do nothing with our money. The bank goes out there and it invests our money, right? So a portion of the bank's money, maybe they're going to use and they're going to go out and they're going to put into something like US Treasuries. And a portion of the money, maybe they're going to put into something like home loans. In another portion, maybe they're going to put money into more higher risk investments like business loans or something like this. And then with a certain part of their money, they're actually going to have a portion of their company that's called a proprietary trading desk, or what we know as prop trading. And if you've ever watched that TV show called Billions, you saw this in effect, but basically the bank will take a certain portion of the deposits and they would open up a proprietary trading desk, which basically means, let's say, for example, there was $10 million here that was in this proprietary trading desk. They'd go out there and they'd look for really good traders to go out there and trade their money. So it was a win for the prop trader because the prop trader would now get access to, let's say there was 10 of these guys, they'd each get access to like $1 million to trade with. This was a win for the bank because they were able to have different people trading different strategies, which was ultimately generating them a yield. And again, it was a win for the trader because they're getting access to large amounts of capital to trade with. And generally, these people were very well paid because they could actually go into the market and make money. So it was a win for the bank. It was a win for the prop trader. And it was a win for whoever was depositing their money into this fund. So this is historically how prop trading or prop firms actually worked. Now, for the past 10 years, we've seen these boom of online Forex prop firms, and this is how they're actually making money, which may come as a surprise to you. And if it doesn't, then the next thing I'm going to tell you about may come of a big surprise to you. But the way that prop firms make money today, let's say, for example, like FTMO, or, we just saw the huge fiasco with My Forex Funds or True Forex Funds or the Funded Trader program. There's a million of these different prop firms that are popping up left and right. But the way that these prop firms actually make money is by people going out there and taking these tests or these challenges. And let's just say, for example, that each test costs $500. So the way that this prop firm works is not like how they used to work back in the day in the example that I just showed you, but they more work on kind of like an insurance model. So if you think about insurance companies, say car insurance, for example, they have hundreds or thousands of customers that are paying this $200 per month premium. And let's just say, for example, for easy numbers, that there's 100 people that are paying this $200 per month premium. This would give the insurance company basically $20,000 per month in income, and they simply just know their numbers. They know that of these 100 people, X amount are going to get into an accident and file a claim, and we're going to have to pay out, let's just say, $10,000 per month. So they make $20,000, they have $10,000 in claims, and they have a positive $10,000 per month in net income. So the way that these prop firms work is very much the same. They know how many people are going to fail and how many people are going to succeed. So the way that this may shake out for a prop firm is, let's say that people are taking these $500 tests. So they have $500 test fee. And let's say that, for example, there's 100 of them, again, that go out there and become customers. If we multiply that together, that's basically going to give us $50,000 in revenue. Now, the prop firm, again, they know their numbers, but this time their expense is the people that actually become profitable traders. So let's just say that 2% of the 100 or two actually become profitable traders. And let's say, for example, that they each make a $5,000 withdrawal. Then that's 2 times 5,000. That's $10,000 in their expense. So just to calculate it, right, we have $50,000 in income from test fees, $10,000 in withdrawals. So all the prop firm is essentially doing is they're taking all of the losing traders to pay out the winning traders. And this is what was just exposed, obviously, from my Forex funds. I think a lot of people had an idea of how this was actually working, but the vast majority of times, FTMO, my Forex funds, True Forex funds, all of these prop firms are not actually taking these funded traders' orders to market. And as a matter of fact, the vast majority of people are actually trading a demo account when they get a funded account, right? Somebody takes the $500 test. Let's say they actually get funded a $100,000 account. Well, it's not actually like they're getting a $100,000 account at first. They're really trading a demo account. And if they happen to make money on this demo account, then they're just paid out from the people that failed the challenge. So in the previous model of how prop firms actually used to make money, it was a win-win scenario, right? When the prop firm made money, so did the trader and so did the investor. However, with the way that prop firms work today, the prop firm actually a lot of the times loses money when the trader actually makes money. So there's a serious conflict of interest where they actually, unfortunately, want you to lose. And that's the reason that I'm making this video, is because I want to see you win. And I'll show you a way where you can win despite all these odds. Now, with all this being said, this isn't always the case. I have to introduce you to something called A and B book brokering. So this happens with prop firms. This also happens with Forex brokers, but there's a difference between what's called an A book and a B book. And an A book basically means that the broker is basically just like a middleman, and they are pushing your orders through to the liquidity provider. Now, with that being said, when someone is being A-booked, or a broker is A-booking the term, then the broker only makes money on the spreads, which is the difference between the bid and ask price, which I'll explain a little bit more in a second. And they make money on the commission, right? Which is what they charge you to actually execute the trades, right? So these are the two ways that the broker's actually going to make money. Now, what's a lot more common, especially with prop firms and a lot of unregulated brokers, is something called being a B-book broker, or B-booking. And essentially what this means is that they are not actually taking the trade to the market or being a middleman. They're actually taking the opposite trade as you. So that means that when you actually win, the broker loses. And when you lose, the broker wins. And the reason why a lot of brokers do this is because ultimately they know that more people are going to lose money than make money. And so it makes sense to take the opposite trade of them and actually trade against them, because this is a more profitable practice, even though it's not exactly ethical. So now let's get back to these profitable traders, because you may be thinking, well, if these guys are actually profitable, good traders, isn't it a big risk for them to B-book these traders? And the answer is absolutely yes. Brokers or prop firms, if somebody's very profitable, it is a expense on their balance sheet, which is not a good thing, right? So in certain cases, they may actually A-book a trader if they found that this trader is successful. Now, a lot of times from what I've heard from some of my friends that own prop firms is they generally are going to wait till somebody actually gets like 3 payouts. And the likelihood of somebody getting 3 payouts is really, really small. But if somebody shows that they're good enough and consistent enough to get like 3 payouts, then they may go ahead and put them on an A-book scenario where they're just making money on the spreads and commissions and acting as like a middleman, sending the order to the liquidity provider. Now, the thing that I wanted to shed light on that a lot of prop firms and B-book brokers use, unfortunately, is something called a virtual dealer plugin. And when I first heard about what a virtual dealer plugin is, it actually made me sick. And then I just realized this is the game that we're playing in. So what a virtual dealer plugin is it's simply just a small little piece of code or software that brokers can put onto their brokerage or onto their price feed to manipulate the market. So here's a few things that this virtual dealer plugin can do. Number one is it can do something called an order rejection, which basically means that if you go in and you place your order, it can not accept your order right away, or it can reject the order and then place you in at an order that is not as favorable as a price. So this is a reality of one of the things that a virtual dealer plugin can do. The other thing that it can do is it can re-quote you. So similar to like an order rejection, but let's say that you're trying to get in at this price, and then when you actually enter the trade, it gets you in at a worse price. This is like a re-quote. So you thought you're getting at this price, but you actually get in at this price, which is actually less favorable than what you thought of. And again, you may be thinking, why would a broker do something like this? Or why would they do something that's so untransparent or manipulative? And the answer is because if they're doing B-booking, then it's in their best interest for you to lose because they're taking the opposite side of the trade as you. So they want to actually see you lose because that actually makes them more money. Now, granted, this whole A-book, B-book thing, if you're in a regulated place like in the US, then the chances that this happens a lot less frequently, but I'm not saying it can't happen. I've seen prop firms in the US that are using virtual dealer plugins clearly. The third thing that a virtual dealer plugin can do is it can pre-program in slippage. So this is a really easy way to see if the broker is using something like a virtual dealer plugin is because of slippage. So what is slippage? Slippage, let's say that you would like to get out of the trade right here, okay? And what ultimately happens is you don't get out of the trade where you put your stop loss. It actually slips and you don't get out of the trade until right here. So the broker makes a little bit of additional money and causes your trade to be unfavorable. With that being said, you could have slippage that works in your favor, and you could also have slippage that ultimately works against you. And this is a really easy way to see, is to see if there's both positive slippage and negative slippage. If there is, then the chances are this is more than likely an A-book scenario where they're not manipulating. But if you see a situation where there's only negative slippage, if there's only negative slippage, then this is a red flag, meaning that whenever there's slippage, it's always working against you versus positive slippage, which is where, you know, let's say, for example, the same sort of scenario, let's say that you put your take profit here and you actually didn't get out of the market until this point. So you actually made a little bit more money than you originally expected. And obviously this was a buy trade. You're hoping to go this way. Then this is positive slippage. So again, a really easy way to tell is to look for positive slippage. If you do see positive slippage, then this is a really good sign. If you only see negative slippage, then again, this is not a great sign, right? The fourth thing that this virtual dealer plugin can do is do something called an order delay, which basically means what it says is you try to get in the market or execute an order at a certain time and it waits or it stalls or it lags for a period of time, or there's some sort of latency which causes you to not get into the market until a later period, which may not be as favorable as a situation for you as the trader. And the last thing that a virtual dealer plugin can do is do something called spread widening. And I've seen this happening on a lot of different prop firms. But basically what this means is the spread, right, is the difference between the bid and the ask line, which you can see here on TradingView here. I'll zoom in a little bit. But that difference is what's known as the spread. This is kind of like the markup that the broker is using. So what the broker can do with a virtual dealer plugin, unfortunately, is let's say again that your stop loss is right here. And what they can do is as they see price approaching your stop loss, they can widen the spread a little bit and it can ultimately bump you out of your trade, which ultimately causes the broker to win. So all of this that I've told you has probably been pretty negative and maybe pretty eye-opening like it was for me when I first heard about it. So what do we actually do with this information? First things first is you just actually have to accept the information because unfortunately, this is the way that the game is being played. And you can either look for more favorable brokers, you can look for prop firms that are more heavily regulated, or you can just man up and accept the fact that this is the game that we're playing in. This is some of the shady stuff that happens. There's shady stuff that happens in every industry. And all you need to do is just be a little bit better, which is totally possible. And if you'd like to see how we're overcoming all of this, B-book brokers, how the prop firms make money, virtual dealer plugins, and how we've been able to help over 600 people become professional funded prop traders, then go to propfarming.com right now. When you go to propfarming.com, I'm going to show you a quick 10-minute demo of how we've been building trading algorithms that are constantly changing and adapting to changing market conditions to beat the market despite all of the odds that we've been talking about. Hey, and if you found this video helpful, then make sure that you like, comment, and subscribe so you don't miss other helpful videos that are coming on this channel later this week.